Good Wednesday morning. This is Yahoo Finance Live. I'm Brian Sozzi. That's Brad Smith. And that right over there is Julie Hyman. It's a busy day in the world of business, so let's get right to several things you need to know as the clock hits 9 a.m. Domestic flight departures in the United States are slowly starting to resume after the FAA suffered a major system outage this morning, leading to a nationwide grounding. We'll bring you the latest in just a few minutes.
Plus, Apple is making its own in-house screens for its devices in a major blow to Samsung. This is just the latest in the company's sweeping effort to make more of its products in-house. But which companies will it end up hurting the most?
And to check up the markets, as futures this morning are higher across the board. Nasdaq gained its third straight winning day for the first time since November. We'll keep a close eye on trading as we're about 30 minutes out from the start of trade. But we got to get to that top story today.
Yes, we do. Flights across the U.S. are returning gradually to normal operations after the Federal Aviation Administration ordered all airlines to pause all domestic departures until further notice due to an outage in a major FAA system that sends messages to pilots. You're looking right now at a live shot of Reagan Airport there. Don't see any planes moving, at least not at the moment. Let's bring in Anthony Roman, founder and CEO of AC Roman. He's also a licensed pilot, and also Mike Boyd, president of Boyd Group International. Gentlemen, thank you so much for being here. As we see this situation, it seems gradually getting back to normal, but it does raise questions about the sort of the fitness of our national transportation system. Anthony, I'll start here with you. It doesn't seem like this thing happens this often at all. How vital is this system that went down to pilots?
It's critically vital. Pilots receive all types of notifications with regards to hazards or weather conditions or runway conditions that are present in and about all of the airports. So it plays to passenger safety very critically. All flights were paused. It appears that they're reloading the system at this time and conducting software validation checks. So we should start to see a release of some airplanes. We're starting to see some flights departing out of Hartsfield Airport in Atlanta right now.
Okay, and so additionally here, maybe you can walk us through, Mike, exactly what takes place from the airline operator side. We had already seen some of the alerts and warnings start to trickle in from airlines as the FAA was undergoing its own procedures. We had actually gotten notifications either via Twitter or even into Yahoo Finance directly from Delta. And what checks do they need to go through to ensure that everything is safe and they could operate as normal?
Well, they're the recipient of this. If they're not getting what they need from the FAA, as the gentleman just said, they can't move. It's a safety issue. But there's a bigger issue here. How did this happen? Number one, it's one thing for Southwest to go down. That was the Grinch that stole Christmas. It was a terrible thing. But this here is a situation where our entire national system could go down. The real issue here is how bad off is the FAA and how desperately we need people who have aviation experience running the thing to make sure this doesn't happen again, because airlines cannot fly without the FAA operating normally or operating efficiently. That's not happening.
Mike, for those not familiar with the inner workings of airlines and the FAA, how outdated is our technology or this infrastructure that we rely so heavily upon?
Well, we've been banging on this for the last, 30 years about the need for a free flight approach to air traffic control. The problem is we're way beyond the issue of having vacuum tubes and things like that. It's gone way beyond that, been improved. But the real issue here is we don't have aviation professionals running the FAA. We have political appointees. So the people in the FAA can't do their jobs efficiently when the people at the top every few years are replaced by another political appointee. And that's about to happen again, I fear. So for the airline industry, they're kind of the victim in this thing, and so is the flying public.
I'm just looking here, unless I'm looking at the wrong thing here, Mike. Billy Nolan is the acting FAA administrator, I believe. It looks like he does have a flight background, no?
Yeah, but take a look at Phil Washington. He runs Denver Airport. He's a very great guy, but he doesn't have a depth of experience in aviation. That's what they want to put in there. We've had some great people running it, but right now, Mr. Nolan is not in line to become the FAA administrator. A political appointee is. That's what has to change.
Anthony, if we were to put a price tag or even, begin to kind of spitball a price tag in order to really get the system the updates that it needs, what kind of cost are we talking here?
We're talking massive costs, and we're talking years for implementation. It does need to be done. The system needs to be upgraded. The FAA apparently is always a step or two behind the current technology that exists today. And the free flight system that my colleague was speaking about today has been in planning and in testing for almost a decade at this point, and we yet don't see any implementation date. So we're going to continue to have these cascading FAA problems, and that's superimposed on the pilot shortage dilemma that we have. So in the next 2 to 4 years, we're going to continue to see airline delays and problems, many of which are no fault of the airlines at all.
Anthony, if you were in the air flying a plane when this news hit or when these developments hit, what are your first moves and how chaotic does it get in the cockpit?
Well, it doesn't get critically chaotic in the cockpit because you always have communication with the air traffic controllers. And the air traffic controllers are updated with regard to the conditions in or around the airport. What it does create in terms of hazard is human failure, mistakes of omission. Is some critical information omitted or not passed on to a particular controller and therefore does not go to the flying pilot? And that can create the incidents and accidents that can be prevented by an automated system.
All right, Anthony Roman, FAA licensed commercial pilot, and Mike Boyd, president of Boyd Group International. Gentlemen, thank you so much for taking the time here with us this morning to really wrap our minds around what's taking place and what we'll continue to monitor throughout the rest of the day as well. We appreciate it. Switching gears here, Apple is planning to begin making its own screens for its devices in 2024, its latest move in its effort to reduce its dependence on partners like Samsung and LG. Yahoo Finance's Dan Halley is here with the latest. Dan, what do we know so far about this move?
Yeah, so this is a report from Mark Gurman at Bloomberg, who I think sleeps under Tim Cook's desk. I say that all the time. And essentially, what they're saying is that Apple is going to stop relying on displays designed by the likes of Samsung and LG. Now, this is a big deal because LG relies on Apple's revenue as a major revenue source, or Apple's business as a major revenue source. Samsung, not so much. Samsung, they're obviously a competitor as well as a supplier to Apple. Now, what they're saying here is that, currently in the Apple Watch Series 7 and the iPhone 14, they use OLED displays, right? Basically, they're individual pixels that can turn on and off, and it really provides a better kind of viewing experience, not as bright as something like an LCD display. What they're saying is we're going to get something called micro LED displays from Apple, designed by them. That means that, we have LEDs in every screen that we have now. These are going to be super, super small. The benefit of that is you're going to get the same kind of beautiful colors and deep blacks that you get out of OLED, but brighter. And the reason why it's a big deal that Apple's designing them is now they can go ahead and say, this is the exact type of device we want to build. They're not constrained by anyone else's standards. They can do what they want. And look, it's not as though they're going to go out there and start building a display factory. They're still going to rely on someone else to do it, but it's the same idea that they did when they cut out Intel, where they now design their own chips, and they've seen huge benefits from that, right? If you get a MacBook now with an M1 or M2 chip, you're going to get performance upgrades over the Intel processors, as well as battery improvements, right? So this is an idea where Apple's bringing everything in-house. Tim Cook made his bones on the supply chain side of things. This continues that kind of effort on his part by just making sure that Apple is in full control of their future.
So I think this is a really important distinction that you're making here. Apple's not actually making this stuff. It is designing
they don't make
this stuff.
Yeah, they don't make this stuff.
I think we kind of mush them all together when we think about chip makers, for example, but there is the design and then there is the actual making of it. So this might be cutting out a Samsung, but then who's the actual manufacturer? Does Foxconn make all? I mean, they don't make the chips, for example, right?
No, it would be
TSM does that.
Yes, yeah.
So who will make once they're designed? Who then would make the screens?
It would be probably obviously another third-party vendor. We don't know exactly who it would be at this point. I think obviously LG and Samsung, they're the two largest display makers in the world. So maybe they could still be building them, right? But what matters is that it's Apple designing them. They don't have to pay up for the designs of these. They don't have to pay any kind of contract for that. It's just the construction of them that then goes on to the Foxconn plants where they're assembled as part of an iPhone. The first thing we're going to supposedly see this new technology in is the Apple Watch. Could be the next generation Apple Watch Ultra. That's the $799 watch. Not really my kind of thing. I'm not climbing mountains or going deep sea diving. So, I just want something that tells me when to wake up. But, it is interesting to see Apple moving in this direction. As I said, this is Tim Cook's kind of lane to really play in. They've had issues with the supply chain before. This isn't going to solve their supply chain problems that they've had in China, but it will allow them to design and hone the devices to their standards that they see fit. And, to that point quickly, they are exacting with what they demand out of their partners. So they're going to design this display. The problem then becomes who's going to make it, as Julie, you were alluding to, and then how long will it take them to get up to Apple's speed, right? That's something that we've seen. That's why it's taken so long for them to move into India, into Vietnam, because they have these demanding specifications that they want these people to meet. And if they don't, then that's just a waste of time for them.
Dan, I like that Apple band color. What is that? Seafoam green? Seafoam blue?
Let's call it a baby blue with specks of paint from painting my nephew's room.
All right, send me that link. Dan Halley, you're the man. Thanks so much. All right, attorneys for crypto exchange FTX are heading to bankruptcy court today in Delaware to ask for permission to auction off pieces of its business to keep customer names secret for at least 6 months as it looks to recover lost funds. Let's dive into this one further here, guys. Some really big names tied to these legal proceedings here. Tom Brady, Robert Kraft, you name it, really catching some headlines.
Right, and we're almost a year removed from the Super Bowl of crypto, if you will. That was last year, that saw a flood of advertisements taking up a ton of the television time, and users or viewers of the game, rather, just having a consistent flow of information that was put in front of them trying to market crypto, whether that be a commercial that said nothing, and that one coming from Coinbase at the time, and then there were the range of other different athletes that were involved in those advertisers, in those ads, and then the sponsorships and partnerships came to light as well in the weeks following that.
Yeah, and there's an FTX hearing that's occurring this morning in bankruptcy court, so all of these dockets being filed is where we're getting all of this information. There's a lot coming through. Alexis Keenan has been monitoring it for us. Alexis, so a lot of dribs and drabs, or maybe more than dribs and drabs, since we're getting a lot of information here.
Okay, so what Brad was just talking about is the release of the investors' names, the equity investors that poured money into FTX in its infancy. But what the bankruptcy court is addressing today are arguments from, well, they're addressing a lot of arguments, but one of note is a group of news organizations, including the New York Times, the Financial Times, Bloomberg, and others. They are saying that the public has a right to know the names of the customers of FTX. Now, typically in bankruptcy proceedings, the names of creditors would be disclosed, as would be their physical addresses, their email addresses. That's how these things go. But in this case, a little bit different, because you have 1 million plus customers, all of whose privacy are presumably important to them. So that's the argument that FTX's management is making against these news organizations. The management is saying, we don't want to do that yet. Judge, please give us 6 more months to protect the privacy of these customers. They say also the EU has privacy laws that may jeopardize, the company might violate EU laws by turning over these names in the US bankruptcy court. And they also say that the company's value could be jeopardized in its eventual sale. Remember, this is a Chapter 11 reorganization. This company is meant to emerge from bankruptcy. It's not a liquidation. They say that other companies in this space could more easily poach customers if the names are released.
Just to a little bit of precision here that I'm a little confused about. Many of these creditors were also investors in FTX. In other words, if you're talking about people want to know who the big clients are, that's really what you want to know about. Nobody cares about who if somebody invested, even if it was their life savings, a relatively small amount. You want to know who is at risk because they had put money at FTX and now lost that money. Isn't there a lot of crossover between that and people who invested in FTX, the company?
So yes and no. As a bankruptcy court would view these creditors, they're really different. And it's also an evolving idea in bankruptcy court of whether customers or what type of creditor they are. Where do they fall in the hierarchy? And just take a look at the hierarchy in bankruptcy, how it works for creditors. Up at the top, you have the administrative expenses just to keep the lights on, just to pay the lawyers, pay the bankers, pay the people who need to show up in order to keep this thing going. Then you have secured creditors, unsecured creditors below them. These are the two spaces where maybe customers might fall. That would be a good thing. The higher up this hierarchy they could fall. But then you see there at the bottom, the equity holders. That's who these investors are, whose names were disclosed yesterday in bankruptcy filings, including Tom Brady, and including Tiger Global, Sequoia Capital, SoftBank. You had Robert Kraft. You had hedge fund managers Paul Tudor Jones and Dan Loeb. So those are the people whose shares are likely now worthless. Customers in this case have a better chance at getting their money back, or some cents on the dollar, let's say.
All right, we'll see if they provide that 6 months as well on the customer disclosures as well, and trying to protect those customers as well. As we'll see what they do with the investors. Thanks so much, Yahoo Finance's own Alexis Keenan. Coming up on the other side, everyone, why our next guest is warning of a tug of war between the markets and the Fed. We're going to discuss that next.
Price stability is the bedrock of a healthy economy and provides the public with immeasurable benefits over time. But restoring price stability when inflation is high can require measures that are not popular in the short term as we raise interest rates to slow the economy.
That was Fed Chair Jerome Powell in a speech yesterday outlining the sometimes unpopular decisions the Fed has to make to stabilize prices. Our next guest says the divergence between where the market thinks rates are and where they're heading and where the Fed does will be the cause of increased volatility through the next several months. William Blair, macro analyst. Richard DeChazal joins us now. Great to have you here with us this morning. Help us break that down just a little bit more and what the markets are reading into what Fed Chair Jay Powell is saying.
Hi, good morning. Yeah, thanks for having me on. So, yeah, I mean, I think there's this kind of dichotomy between the market and the Fed at the moment, where the market is looking at all of the real economic data, the ISM, small business sentiment, and seeing that it's all kind of leading to weakness, and that should be followed through with inflation. And we are actually already seeing the inflation coming down. We've seen some slowdown in the momentum there over the last couple of months. And we have some inflation data coming out tomorrow, which I think the market will be looking at to confirm that sentiment. On the flip side, though, I think the Fed has a slightly different problem on its hands. It'll be happy to see clearly any moderation in inflation, but from its perspective, it's got a bit of a credibility problem on the one hand. So it doesn't want to get overexcited about any slowdown in the inflation numbers, and then have inflation pick up a little bit later on in the year, and then kind of be caught on the back foot once again, as it was last year. A second problem I think the Fed has is it's as long as the market is kind of pricing in a pivot or a pause, that helps to bring down financial conditions or ease financial conditions, which is the main channel through which the Fed's monetary policy acts. And any kind of premature easing in the financial conditions then takes some of the weight off what the Fed is doing. So the Fed clearly wants to keep the market expecting rates to be higher, pushing up above 5%, and the market right now is kind of pricing in rates staying just below 5%. So you're kind of getting this tug of war going on between the two.
Richard, when do you think the economy will start to show tangible signs of the Fed's rate hikes from last year, and what do those impacts look like?
So I think it's just starting to show. I mean, Powell likes to say, and we've heard a lot about long and variable lags of how monetary policy operates through the economy. And I think, the initial stage of higher interest rates, we saw a lot of that taking place last year. That was really through financial markets. So we saw a big correction in financial markets. And then the sort of second phase, I would say, is really in the most interest rate sensitive sectors of the economy. So housing, autos, that kind of thing. And we really have seen a big correction in the housing market already. We're waiting for that to start to filter through into the inflation data. So looking at tomorrow's inflation report, the shelter component will be a very important part. Are we starting to see that starting to the real economy data starting to filter through to the inflation part of that? And I guess the third part, is we haven't really seen much yet, and that would be kind of on wages, labor market, those sort of areas, kind of coincident to lagging indicators of the economy, which have been a lot slower to feel the impact of those rate increases just yet. And I think Powell is kind of alluding to this, that this is not an economic cycle that is being driven by a pandemic or a financial market crisis, where all economic indicators and inflation are really, coming down at the same time. This is a cycle that's seemingly driven by income growth, excess stimulus, and a Fed that is now having to come in, break that cycle, raise interest rates, and that has an impact that's kind of rolling across the economy at different periods. And I think what the Fed has been looking at is inflation and in three different buckets, the first being goods prices. So as I alluded to earlier, we've had the opening up of the economy, supply chains improving, and those goods prices have been coming down quite significantly, used car prices, for example. The second component, shelter, as I mentioned, housing, that's kind of rolling through now, and we're starting to see shelter components having a more moderating impact on inflation. And the third component, which Powell has really highlighted, has been this core services, less shelter component, which is kind of the stickiest component of inflation. That's really driven by domestic demand. It's driven by wage growth. That could be things for like prices for haircuts. And the Fed really wants to see those coming down in a more meaningful way before it really feels confident that it has squashed the higher inflation for the time being.
Well, we'll see if we get some signs of any of this when we get that data tomorrow. William Blair macro analyst Richard Deshazal, thank you so much. Appreciate it.
Pleasure. Thank you.
Coming up, the return of the memes. We'll talk about that and the opening bell next. We still have a few minutes till the opening bell. Let's take a look at a few hot tickers here this morning, and it's some that have been here before, some familiar names here. Bed Bath & Beyond, GameStop, Party City, AMC. What do they have in common? They have all been known, well, maybe with the exception of Party City, maybe it's now a meme. They've all been known at one time or another as meme stocks. Two of them are contemplating bankruptcy, reportedly. The last two on that list, Bed Bath & Beyond, as we've talked about extensively, and Party City as well, which reportedly has sought funding for a potential filing of Chapter 11. The other two, as far as I can tell, there's no news on. They're just memes.
Just super speculative moves in Party City and Bed Bath & Beyond. And Brad, you mentioned we were talking about the Bed Bath results yesterday. They didn't mention the word bankruptcy. I think you controlled F'd it. So just that fact alone, I think, has sent Bed Bath shares rising. Party City, this was a company that came out in early November, had a horrible Halloween season. That is a key. I think it represents about 25% of their annual sales. Now there have been reports that they are nearing debtor in possession funding or DIP funding that would help them survive a potential bankruptcy. That was according to Bloomberg Law this morning. Party City didn't return my request for comment on a potential bankruptcy filing, but again, super speculative move on companies that may not be around a year from now.
Well, yeah, and at the same time, they'd already received a delisting notice from the New York Stock Exchange under their rules. Looks like they have a 6-month period to get back into that minimum share price requirement. And you mentioned Party City's earnings. Well, they blamed balloons in their most recent quarter and slumping sales of balloons within that anagram division as well. And so they need to see more wholesale balloon orders come through.
Who doesn't like balloons?
Anybody who watches it doesn't like balloons.
I love balloons. Oh, they're just always so happy and friendly, especially the animal balloons. Oh, those are great.
Balloons are fine.
Balloons
I
are fine.
have strong feelings about balloons, but I do have strong feelings about people buying stocks of nearly dead retailers in the hopes that they can make some money.
They're buying.
I guess they made a quick buck this week if you bought it on Friday.
Yeah. Sure.
I guess.
They're thinking, ooh, 59 cents for Party City. I see a Party City down the street from my block. It's still open. Well, no, it doesn't mean that's how it works. I mean, they may declare bankruptcy and the stock essentially goes to zero. So, yeah.
Right, exactly. So buyer beware, I think is what we say in this case.
Don't get a balloon.
We'll leave seeing GameStop aside for a moment. They just seem to be getting caught up in that momentum. Here's the opening bell on Wall Street, and the nonprofit organization God's Love We Deliver is ringing the opening bell, as you can see, virtually and very festively on this Wednesday morning. In terms of what we're looking for stocks, as we just talked about with our last guest, really a lot of investor focus is on tomorrow and tomorrow morning's CPI data. Ahead of that, though, it does look like we are seeing some early gains for stocks this morning. So kind of this upward momentum that we've seen to start the year, the Nasdaq going into today's session with 3 up days in a row. So if it rises today, this could be a 4-day winning streak for the Nasdaq. An index that sorely needs it, of course, if you're a bull.
Beth Beyond leading the market higher there, Brad. Party City, too. Really powering that rally.
That far.
Okay.
Green, we'll leave it at that. The Dow Jones Industrial Average, so that also seeing some green on the screen. It's up by about 0.4%. Net positive for the past 3 days, up by about 0.6% there. Nasdaq Composite, tech-heavy average out of the gate. You're seeing that higher there on your screen by about 0.5%. Past 3 days, it's been pretty good as well. That's up a little more than 2%, 2.2%. We'll round that off to and be generous. And then the S&P 500, you're seeing that higher by about 0.5%. 3-day period, 1.1% in gains there. Let's take a look at some of the sector activity out of the gate this morning. You've got every S&P 500 sector, all 11 of them, call them green in positive territory. Real estate actually leading the charge here on the day. It's up by about 1.4% early in trade. The material sector also, that's one of the bigger gainers on the day. That's up by about 1%. Energy up 1%. And then all of the other 11 S&P 500 sectors in the green too. And then additionally, I just wanted to check in on some of those travel names, given the alert and notification that came across earlier this morning, and it seems like some of those issues have now started to be abated, and we're just keeping a close eye on some of the airliners here on the day. You've got Delta Airlines, United Airlines, and American Airlines all in negative territory right now. Also seeing if I can see some LUV here on the screen. That's down by about 1.7% for Southwest Airlines. So we'll keep close tabs on some of those airline operators, given the NOTAM, which is probably a new acronym that many of us will remember for at least the next 24 hours.
Yes, or until we get on a flight again. And just a couple of updates from the Federal Aviation Administration. They say normal air traffic operations are resuming. The ground stop has been lifted, and they're continuing to look into the cause of the initial problem. I'm also seeing some headlines that the Senate Commerce Committee Chair, Maria Cantwell, Democrat of Washington, says that the Commerce Committee will investigate the cause of the FAA computer system outage that triggered those delays this morning. So, because we don't know why it happened. Was it just, as we talked about with some guests at the top of the show, that there are old systems that need to be updated? Is it that there was something more nefarious going on? We just don't have that information right now.
In which case it comes back to an allocation of funds in order for them to spend necessarily, in which case some lawmakers might need to just go look in a mirror, honestly.
Right. Well, and Mike Boyd was also talking about expertise at the FAA,
Yes.
so that might be part of it.
Like that hot take, Brad. All right, let's switching gears here. Shares of World Wrestling Entertainment are on the move this morning following news that co-CEO Stephanie McMahon is resigning from her role. This comes as her father, Vince McMahon, returns to the company as executive chairman of the board. With the departure of Stephanie, Nick Khan will now serve as the sole CEO of WWE. Lots of speculation, guys, around this name. There were reports floating around on Twitter, unconfirmed, I should say, that WWE has sold out to Saudi Arabia. Unconfirmed.
Well, it looks like sometimes they were in some cases they were refuted. Maybe one of the tweets was deleted.
Yes,
so
I reached out.
Be very careful about that.
Yes, I reached out to WWE for comment on this. They have not returned my request for comment. But again, the future of this company very much hangs in the balance, and is really very much back in control of the man you see on that screen right there, Vince McMahon, and the 2 handpicked former executives he now plants on the board.
Yeah, this was trending and it continues to trend on social media, specifically on Twitter this morning. And it really kind of highlights how quickly some of the sentiment from the actual viewers, the fan base of WWE, and for some of the performers involved within WWE, how that can quickly shift, may quickly shift if this turns out to be true. And where might some of the new wrestling federations that have come about where might they get some new fandom that may come about as a result of this, depending upon if it's true? I do find
it unfortunate that Stephanie resigned. Now, she did take a leave prior to her coming back. This was an 8-month position that she had. She loves this brand. I've had the opportunity to talk to her a few times. It's sad. I would have liked to see her continue to lead this brand forward. It's something she cares about, and I think she could have transformed it in a good, positive way.
I mean, it's interesting to me that the Saudis are being floated as a potential buyer of this organization. As we talked about earlier in the week, Vince McMahon has some baggage, right? Yes, there are a lot of people who are close to him in the industry, but he also, according to the Wall Street Journal, paid over $12 million over the past 16 years or so to suppress allegations of sexual misconduct. And as I talked about at the time, he would have to find a buyer who would be okay with that. Right. Maybe he found one in the Saudis. I don't know. And this would add to some of the sporting ambitions that the Saudis have. I believe you pointed this out in our Slack. Exactly. And so with that, just another instance where they're looking to get into sports, and some could call that and have called that sport washing, and trying to just get into kind of the fandom in order to kind of paint a different picture for the country and for its sovereign wealth fund as well. We'll continue to track to see if there's any more news that comes around the WWE for you, but we're also tracking shares of CRM here on the day. Salesforce, and they're moving lower right now by about 1.4%. This is following a downgrade to underperform by the folks over at Bernstein, saying that the software company is falling into growth purgatory. Bernstein also slashed its price target on Salesforce from $134 down to $119 here. And they pointed out a few things within this note, but specifically, I think it does come back to what many others have cited in this, either seat count compression as it hits on headcounts, and that headcount reduction for some of the portfolio clients for Salesforce or CRM, what that means for the actual license base that Salesforce has really relied upon, plus the acquisitions and those now being accretive to the business. Where do they kind of seek out new opportunities, and how might that be scrutinized given the acquire to growth strategy that many of the ERP players do have right now?
Yeah, this is top work by Bernstein analyst Mark Mordler, 38-page report, very extensive, and bringing a lot of key issues to light. One, I think, takeaway from this is what Mark notes at the top of the report, that of course, Salesforce last week announced a 10% workforce reduction. I think Mark is trying to argue, as you get rid of those workers, that top line growth will slow. And even though you get margin improvements by laying people off, they may not be as great as investors now expect. Very key takeaway that Mark's making there.
Yeah, won't really help margins.
Absolutely. We're going to continue to watch all of those companies' shares. But coming up on the other side of this short break, Yahoo Finance's own Inez Ferre is going to break down the latest market action ahead of key inflation data tomorrow. That is next. Welcome back to Yahoo Finance Live this morning, everyone. We're taking a look at the major averages here in the U.S. We're higher across the board right now. Let's get on over to Yahoo Finance's own Inez Ferre, who's got more on the Wi-Fi Interactive. Inez?
Yeah, Brad, and the S&P 500 up for a second straight day in a row ahead of that CPI print that's coming out tomorrow. It's up now 0.5%, about 0.5% for the S&P 500 on our Wi-Fi Interactive board. On the Nasdaq, we are watching the Nasdaq higher, also by about 0.5%, and the Dow is up about 0.3%. Taking a look at the 10-year Treasury note, that's sitting at 3.58% for that yield. And then looking at the sectors, we have been seeing real estate that is gaining. Consumer discretionary stocks, material stocks, those are in the lead. And we're watching healthcare that's taking a bit of a dip right now. Over on the Dow, we've been watching Microsoft up 2%, Home Depot, the leaders on the Dow. And on the Nasdaq 100, the mega caps like Amazon up more than 2%. You've got Alphabet that's also higher, Tesla also up 2%. The semis are seeing a little bit of a pullback, even though the semis have performed relatively well this week. I'm pulling up a 3-day chart here so you can see the semiconductors over the last 3 days. Also, the Chinese ADRs, this is still a 3-day chart. Pulling up the intraday, we are seeing a little bit of a dip for those Chinese ADRs. And then looking at the travel stocks, we had seen in pre-market the travel stocks under pressure after temporarily grounding flights over that FAA snafu. But look at right now, we are seeing the travel stocks in the green. And I want to point out what's been happening with commodities, because we have been watching oil today that is going higher. We're watching WTI up more than 1.5%, and Brent crude also higher. I want to mention also copper futures, because we're seeing copper. I'm going to pull up a 1-year chart. We're seeing copper at levels it hasn't seen since June of last year, and this is fueled by optimism over China reopening, guys.
Yeah, thanks for flagging Tesla, Inez. That stock up about 6.5% over the past 5 trading sessions. Inez Ferre, thanks so much. All right, speaking of buyers, they have emerged so far this year as traders seek out bargains. They're tossing the trash in 2022. A total of 56 out of 68 S&P Composite 1,500 industries are up year to date. Airlines are leading the way with an 11% gain. Meanwhile, healthcare providers are leading the way lower with a 5% drop. Straight ahead, Bed Bath & Beyond short sellers are having an interesting week. We have the data you need to know next.
shares of Bed Bath & Beyond are taking off as potential bankruptcy looms and speculation of a takeover makes the rounds. Volatility in the meme stock name over the past year made shorting Bed Bath & Beyond a lucrative trade. But what does the short interest picture look like now for the company? For this and more, we have Ihor Dusanowski, S3 Partners Head of Predictive Analytics. Ihor, good to see you. Always good to catch up with you and the great data that you guys provide. So talk to us about Bed Bath & Beyond. Now we've seen it bouncing for a few days. Has some of the short interest in this name been sort of worked out here?
You know, this has been a big short for a long time, and it's really been a really busy short since it hit its recent highs in late March. We saw 25 million shares shorted since then, and another 3.6 million shares shorted in 2023. So shorts aren't going anywhere, and it's one of the bigger, more crowded shorts in the market right now.
Is any type of short covering the kind of event that would really lead a concerted rally next from here?
Yeah, it's really interesting because we're looking at possibly a bankruptcy stock. So most short sellers are going to hold on. If I got a chance for the stock to go down to zero, I'm going to wait for it to go down to zero. That's what they're thinking. What we're also seeing is that while short selling and short interest on the institutional side has gone up by around 2/3 over the past year and change, institutional long holding has gone down by around 2/3. So this is really a retail stock. We've got our Black app, which is kind of looks at the long side of the market now. And it's showing that active and passive shareholders went from 140 million to only 40 million shares held long. So this is going to be a really volatile stock.
Ihor, how long do you think the short squeeze in Bed Bath can continue? For the average investor out there trading almost a $3 stock, what signs should they be looking for?
Well, this is an expensive stock to borrow. We're talking about new shares to borrow to cover your short sales going at around 40%. So it's eating your profits up every single day. We're going to see, short sellers hold on for a little while longer until, the market kind of pops up a little bit. But yeah, I don't see the shorts leaving the stock anytime soon.
Ihor, I want to move on to some of the other stocks that you track as well, including the likes of Tesla, which was also enormously shorted last year. Do we see anything different this year? And I also wonder, the calendar is a construct, et cetera, but do we tend to see a clearing of the decks with short interest when we head into a new year?
For some of these big names, it's the name you love is the name you stay in. Shorts have made, we're down $15.8 billion in mark-to-market losses in Tesla last year. So you would think that most of these guys got out of their trade, but not so much. We've still seen short selling go up in the name, and because the stock price keeps going down, and short sellers made $15.8 billion last year. And we're still seeing people shorting the name. Of course, they lost $40 billion since 2010. So they get a lot to catch up.
This, for Tesla, it's really the second largest short, just behind, as our viewers are seeing there on the screen, behind Apple and Microsoft, or just ahead Microsoft. With all of that in mind, for two of the larger tech companies out there, for Apple to have the amount of shorts that it does, what does that indicate to you about the sentiment around even big tech or mega cap tech, given that it's fallen so far because of the broader market declines, and along with the broader market declines that we'd seen in 2022? And what would it take for that to reverse course?
Yeah, Apple is an interesting short, but it's not only a fundamental short on the stock because people are worried about the China exposure and demand for the new iPhones. It's also a short to hedge technical long exposure. So if I'm long a big block of technical stock in my portfolio, I can either short using one of the ETFs or some futures, but it's much easier for me to short Apple and have a short that covers some of my long exposure on the long side in one simple name. So a lot of that is hedging short selling.
Bigger picture here, if at some point soon we do get a sign of a Fed pivot from the Federal Reserve, what does that mean for the short selling community?
December saw a tremendous amount of short selling, over $90 billion worth of new short selling just in December alone. January slowed down a little bit. We see around $10 billion worth of short selling right now. If this market turns around, you're going to see a lot of these shorts that put on recently just start covering their positions. So you're going to see a little bit of turbocharge to the rally if the short sellers start buying to cover. So let's wait for the market to go up a little bit. Shorts get a little skittish, and then they're going to start covering because they want to realize some of their gains that they had in 2022 and not blow them up in 2023 if the market rallies.
Interesting. We'll see, though, if any kind of rally can be sustained. Ihor Dusanowski, always good to talk to you. S3 Partners Head of Predictive Analytics. Thanks.
Thanks for having me back. Take care.
You too. Coming up, it's been a tough start for PC makers in 2023 after a tough 2022. Also, Saz is going to share his take next. The holiday quarter showed a sharp drop in global shipments of personal computers. That's according to new research from the International Data Group. Every manufacturer, with the exception of Apple, saw double-digit declines, and that data is where we find Saj's take today.
Otherwise known as IDC, coming at us with some very depressing data. Fourth quarter unit shipments for PCs or for the industry down 28% year over year. Really a horrible plunge for an industry that came under pressure a lot starting last year as people just stopped buying PCs because they didn't need them. They bought new ones during the COVID-19 pandemic. So that 28% decline was worse than Citi's estimate for a 22% year over year decline. Also worse than the 16% year over year declines in each of the second quarter of last year and third quarter of last year. So another way to look at that is the declines are just getting worse and not good for major PC makers. Now, there were a couple bright spots amidst this absolutely depressing data. Apple gained market share as well as Asus. So Apple and Asus were winners in a challenging fourth quarter. Market share gainers there. Market share losers, according to IDC, Lenovo, HP Inc. and Dell. Dell losing almost 1 percentage point of market share. Very interesting there as well. They were a big market share loser in the fourth quarter. Now, going back to Citi, what they're saying here, and I think which you need to be mindful as we start to get earnings from Dell and HP and over the next month, they're saying consumer demand remains soft because of the, as I just mentioned, the COVID purchasing the year before. So that is a problem. Also, that the outlooks may be tempered when a lot of these companies report. So you could get the fact that we get weak quarters from both of these makers, but also weak guidance because the first half can be very challenging. Citi noting perhaps you get a pickup in commercial and consumer PCs in the second half of this year. But again, that remains wildly uncertain. Fire my take here, guys. My take is this. As I just mentioned, here comes the PC profit misses. HP, very well-run company. Dell has been cutting a lot of expenses, but still, if that top line is under pressure, it's going to be hard to make some of the, I would still argue, some of the aggressive earnings estimates out there for the PC sector.
Yeah, it's a question of, on the corporate side, how many of those corporate partners in the B2B part of their businesses and selling through some of that PC are still buyers on a reduced headcount environment. And then additionally, on the gaming front, if gamers are saying, you know what, I need to swap out my PC instead of just saying, yeah, I just want to get that new graphics card chip.
Yeah, look, basic analysis here. If you're Coinbase, we had Coinbase news yesterday. They laid off another 20% of their workforce. That's 20% of the workforce that no longer works at Coinbase, and they don't need new computers.
Yeah.
Well, we break it down. That's what we do here.
Pretty straightforward.
That's what we do here.
Absolutely. Well, we'll keep close tabs on all of those companies and their ticker symbols and more. Coming up, we'll give you the latest update on the airline system outage. That's coming up next. Welcome back to Yahoo Finance Live on this Wednesday, January 11th. I'm Brad Smith with Brian Sozzi and Julie Hyman. Let's get a check on the markets as we reset this hour. As we've hit the top of 10 a.m., major averages here in the U.S. They are higher across the board. There you've got a good look at the Dow, the S&P 500, and the Nasdaq in the green. We've got much more during this hour, including the airline industry. Can't seem to catch a break. Thousands of flights, they're delayed this morning after a major FAA system outage, which caused a nationwide grounding earlier. We'll bring you the latest on that developing story. And hold your applause. Award season kicked off last night with the Golden Globes. We're going to break down which A-listers took home the top awards later on in the show. But first, air travel across the U.S. is now slowly resuming after a pilot communication system failure led to major disruptions earlier this morning. Here with the latest, we've got Yahoo Finance's Pras Subramaniam. Pras, what do we know now?
Hey, Brad. So, yeah, these flights were kind of delayed early this morning because of an outage in one of the FAA systems known as the NOTAM system. Now, this is a system that warns pilots about hazards like runway closures and bird strikes, things like that. So what happened was from a FAA official says that it was a cascading sort of failure of IT failures that led to this outage. So the FAA had to shut down or ground stop flights around 7 a.m. That led to around at least 1,200 flights being delayed, at least now. But we're seeing this gradual sort of resumption of air traffic control. So we're seeing the flights start to take off now. But again, a big disruption this morning for many Americans flying, especially for business.
And I guess what now is the question. You know, usually you get a huge ripple effect when this happens. So the number of delayed flights is going up and up.
Oh, yeah, that was just this morning around 7:50 a.m. So we're going to see more and more flights get delayed, get pushed back as those flights get kind of catch up to where they're supposed to be. But I think it sort of lends credence to people talking about how this country might need some more IT infrastructure investments if these systems are going down. And apparently they don't know why it actually broke down. And it led to complete, like I said, cascading failure of IT failure. So there is some issue there. Americans probably not happy about that, especially on the Southwest stuff. So here we are right now. So hopefully these flights today at least will get back on schedule.
Professor Subramanian, thanks so much. Appreciate it. All right, Apple's moving in-house. Recent reports make it clear Apple is continuing development of its own technology to replace everything from the wireless chips currently made by Qualcomm to the LG and Samsung displays its devices use. Joining us to discuss is Ruben Roy, Stifel Applied Technology Analyst. Ruben, good to see you here this morning. So why is Apple making this, and what does it mean to the longer-term margin structure for the company?
So thanks for having me. So Apple's been probably not slowly, actually quite quickly moving to bring more of its chips into a captive capacity. And the reason for that, as you said, is margin. So chip companies, there's a lot of value added in these chips. Qualcomm, Broadcom is a supplier to Apple for many years, and there's a lot of technology that goes into the chips. And with each iteration of an iPhone and each iteration of the cellular technology, we're up to 5G, obviously, moving to 6G eventually. These complexities cost money. So Apple is trying to increase its ROI, and one of the ways of doing that is to bring this very complicated technology in-house.
Any idea or ballpark estimate, Ruben, on what type of impact to the total addressable market for semiconductors a move like this from Apple might have?
Well, the semiconductor industry from a revenue perspective is quite massive. So I think in 2022, we're looking at a $400 billion industry, and Apple's a material part of the industry, but Apple is one customer. I think you have to look at the individual companies. So there are companies with a lot of exposure to Apple, Broadcom, which we do not cover, by the way, and so we don't have an investment opinion on it. But Broadcom does have somewhere around 15 to 20% exposure to Apple for total revenues. So certainly, if Apple were to take some of the technology that they acquire from Broadcom in-house, that would be significant. Other companies like Qualcomm, Apple is a little bit lower in terms of overall exposure. And then, you have to look at the supply chain. My guess is that this is going to take time, and it's going to come in waves, meaning that Apple has flagship iPhones, they've got iPads, they've got other technologies that they're working on that use some of the technologies that companies like Broadcom bring to the table. And these products have to get qualified across different networks, et cetera. So this is not going to be something that impacts companies that are supplying Apple overnight. But over the last 10 years or so, Apple certainly has brought in a lot more of this type of technology in-house, and that's a trend that will likely continue.
So Ruben, to take a step back here, we're talking about this Apple challenge and the sort of rejiggering of suppliers. We were just talking a few moments ago about a drop in PC demand. We obviously know about the inventory correction that's going on in the industry. Are we going to see a gain in semiconductor stocks this year, or are they going to continue to have a really tough time?
We're on the latter side of that debate. We think that the broad semiconductor markets, so when you look at the analog companies, et cetera, which is covered by Tori Svanberg here at Stifel, we're looking right now forecasting for 8 to 10% down revenue scenario for 2023 versus 2022. And that comes in two parts. One is units have been outpacing longer term trends for quite a while now. Obviously, you folks know about the supply chain issues, et cetera, and demand coming back very quickly. post the initial part of COVID with work from home, learn from home, et cetera. And so with units outdoing the trend line, we're expecting a reversion to the mean on that unit number. So units probably down somewhere in the teens. Now that's going to be offset by pricing. The semiconductor companies have enjoyed slightly higher pricing environment, more benign pricing environment than they have historically. And we think that's something that for now is here to stay. Supply input costs have gone up and the semiconductor companies are getting a little bit more ROI. And again, that's one of the reasons that Apple is looking to bring more of that technology in-house. So when we put that together, we're looking for an 8 to 10% downtick in revenue for the broader semiconductor industry. Now, certainly there's companies that have exposure to PCs. You guys were talking about IDC and the fact that the PC market looks to be down 28% year over year in Q4. That's decelerating faster after a 15% decline in Q3. So for companies that have more exposure to PCs, certainly potentially the outcome could be a little bit worse than that 8 to 10% downtick that we're seeing for the broader industry.
And Ruben, for those companies impacted by Apple pulling its production in-house, how do they make up that revenue shortfall? What other markets could they look to?
Well, it's an interesting question. Some companies like a Broadcom have been diversifying quite rapidly. Broadcom's gotten into enterprise software, and they have other other areas like data center networking, et cetera, where they are diversified into. We've seen a lot of consolidation in the semiconductor industry, and that's likely to continue as well as companies try to diversify away from large concentrations of either customers or end markets. I believe that the semiconductor industry in general is going to have a multi-year growth trend that's going to be meaningful. Obviously this year is going to be a little bit difficult, but there are these mega trends that we've talked about and we wrote about in a recent report. When we look at 2023, for instance, AI comes up a lot. I think AI is hitting an inflection point. We've heard all about ChatGPT and how interesting that new technology is as it relates to AI. And I think Fortune 500 companies, enterprise companies are certainly tuned into that. We've heard a lot about the data center and cloud infrastructure build out, and that's something that's here to stay. We've heard about the automotive market and silicon content moving higher as we get into higher levels of autonomy and EVs. And so there's a lot of mega trends that are going to drive growth. So I think the companies that have exposure, again, to single companies or single markets are actively looking to diversify into some of these other areas that should provide nice growth over the next decade.
So, Ruben, if we look at each of those three trends, just briefly, what would be your top picks among companies that are best poised to take advantage of those, starting with AI? And again, just as briefly as you can.
Yeah, just briefly, AI. Right now, we like AMD as an AI play. NVIDIA is obviously the other choice. NVIDIA is trading at a little bit of a higher valuation, but we have to pick one just on valuation. We think AMD lines up really well with the trends that we're going to see this year and in the years to come in AI. And that's one of the ones that we're recommending to investors to look at.
And just lastly, Ruben, while we've got you, when you think about the overhang that U.S. and China relations have been on the semiconductor space, do we see any of those issues solved for or abated this year?
I don't think so. I think this is going to be an ongoing issue. And I think it's an area that is going to take multi-years to come to a conclusion on. I think in the meantime, one of the benefits or good things that's come out of the geopolitical tensions here is that we are going to see some more onshoring of semiconductor manufacturing in the United States, which I think is a good thing. I think a lot of the companies that we just talked about have a lot of exposure to certain geographies of the world, and I think having a diversification away from single areas of manufacturing is a good thing for the industry and these companies specifically longer term.
Ruben, good to catch up with you. Ruben Roy, Stifel Applied Technology Analyst on the outlook for chips and beyond. Appreciate it.
Thank you very much.
Thanks. Well, as we see stocks continue to rally, I want to start with a look at the interactive here at what's going on in the bond market, not just today, but what we've seen thus far in 2023. We've seen yields come down. So this showing you yields of about 3.57% on the 10-year, and that's a drop thus far this year. That's a pretty significant one. So even as we talk about many investors saying the Fed's going to be more aggressive than the market is pricing in, that the market's not pricing it in. The market's not necessarily getting the message. So we are seeing bond prices and stock prices here rise to start the year, which is an interesting phenomenon. Looking at some of the sector action today, we're also seeing some interesting moves. All of the industry groups in the S&P 500 are up now, and we are seeing consumer discretionary and real estate lead the way. There doesn't seem to be anything specifically necessarily that's driving the gains within consumer discretionary. Pool Corp, the pool supplies company, being upgraded to buy from holdover Deutsche Bank. LabCorp helping some of the healthcare names rise as well. It's one of the best performers in the S&P, the price target being raised over at Baird. So maybe that's a part of what is going on here. And then if you look at some of the big performers in the Nasdaq here today, and I'm going to sort it to equal weight so we can see what is up the most here. So we're actually seeing Rivian near the top of the list after announcing some management changes, which we'll get to in a bit. Lucid also gaining steam, Peloton. So within the Nasdaq 100, some rebounds from some stocks that have had some recent weakness, and not just recent weakness, but 2022 weakness. Amazon and Tesla are on that list too, which is quite interesting. And then rounding it out, let's take a look at over what's going on in crypto here. Not very big moves, even as we get another day with some FTX news in terms of the hearing and the FTX bankruptcy court talking about recovering a lot of money that was perhaps lost during the collapse of that company. So interesting there, Sas.
Indeed. Thanks, Julie. All right, before we head to break, let's spotlight a bullish pre-earnings call on Tesla from Citi's E.K. McCalley. Says McCalley, we think the Q4 setup is improving. The recent sell-off has been driven by legitimate negative developments and other concerns that we don't think Q4 results alone are likely to resolve. That said, we think weakening sentiment also reflects lack of visibility on key go-forward items, 2023 auto gross margin bridge, delivery and production outlook, and the product cadence for new and refreshed vehicles. We should also note the company is planning to spend more than $770 million on its factory expansion in Texas. Coming up, struggling EV maker Rivian is losing more top execs, as Julie just mentioned. She'll have more on that and other headlines next.
Now to check on some other headlines that we are watching. There are some high-level exits at Rivian as the EV company battles with a slumping share price, missed production targets, and ongoing bottlenecks from supply chain issues. The departures, first reported by the Wall Street Journal, include the vice president overseeing body engineering as well as the head of the company's supply chain. The truck maker's shares are down almost 80% since its 2021 IPO, which valued the company at the time at over $66 billion. Both Rivian and rival Tesla missed 2022 production targets, the former having widespread issues at its plant in Normal, Illinois. And by the way, those Rivian shares are indeed popping today. Meanwhile, shares of luxury goods conglomerate LVMH hitting a new intraday high after announcing one of its biggest leadership reshuffles in years. Pietro Beccari, currently CEO of Dior Couture, will take over as head of Louis Vuitton, while Delphine Arnault, daughter of CEO Bernard Arnault, will take on Beccari's former role. Now all 5 of Arnault's children hold senior positions within the company. Europe's most valuable business has been on something of a tear this year. It's up 13% so far in 2023. It was down about 6% last year. The gains now due in no small part to China's reopening. And Credit Suisse is considering slashing its 2022 bonus pool in half. This according to reporting from Bloomberg News. The troubled Swiss investment bank has spent the last few years trying to reinvent itself after being plagued by underperforming units and damaging scandals. In October, it announced a radical restructuring of its investment banking operation, effectively backing away from Wall Street and focusing more on its lucrative wealth management arm. Sas?
Angela Bassett took home a Golden Globe Award last night. Her role as Queen Ramonda in Disney's Black Panther: Wakanda Forever earned her the award for Best Supporting Actress in a Motion Picture. Yahoo Finance media reporter Alexandra Canal has the details. Allie.
Yeah, and this is the first Golden Globe win for a Marvel movie in history, which is a pretty big deal for Disney. And in fact, Angela Bassett is the first actor ever to win a major individual acting award for the MCU. And this has long been debated in Hollywood, the types of films, the genres of films that typically see the love at these award shows. This was a big topic of conversation last year after Spider-Man: No Way Home, despite crushing box office records, earning nearly $2 billion worth of ticket sales, it did not get nominated for an Oscar. So superhero films just do not receive the same level of prestige, at least from some of these Hollywood award shows. So this could be a potential momentum shift there. Overall, though, if we take a look at the Globes as a whole, and this is an award show that doles out awards for both TV and film, we saw a pretty strong showing from Warner Brothers Discovery, which, by the way, received yet another upgrade on Wall Street from Guggenheim this morning. The combined HBO and HBO Max earned 4 total wins, led by The White Lotus with help from House of the Dragon and Euphoria. That was followed by ABC, Abbott Elementary, just continuing to be an award show darling. And then Netflix with 3 wins, 2 for television, 1 for film. And we did get the news this morning that Netflix has signed a multi-year deal to air the Screen Actors Guild Awards, which will be the platform's first live award show. So this will stream on Netflix's YouTube channel and comes right before the platform will stream another live event with Chris Rock. So another example of how streamers are trying to expand their programming, and also how the award shows too, they're trying to be a little bit more relevant and potentially shake things up.
Well, speaking of the relevance of the award shows, right? We always ask this, like, who cares who wins these awards, right? Does it matter to the bottom line? Obviously, the Oscars is the most prestigious. Do the Golden Globes move the needle at all?
There have been evidence in the past when it comes to box office bumps for certain movies, ratings bumps for certain TV shows. However, I think with streaming coming into the mix, that has sort of muddled the waters in a sense, and I think it's harder to really track that bump. And I think it's also a different time. You know, even for the Globes, it wasn't heavily promoted. I didn't see a lot about it. There was a lot of controversy surrounding this award show, so I'm curious how the ratings will be reflected. But if it's another ratings bomb, I wouldn't be surprised if we saw more of these shows move to a live stream YouTube type of format rather than airing on cable television.
Back to House and Mouse for a second here. Disney listening to guest feedback and making some changes at its parks. So can you tell us a little bit more about that?
Yeah, and there's been a lot of backlash from fans when it comes to long wait times for rides, really high prices. This was a huge criticism in the Bob Chapek era, and now Disney is responding. Some of these updates include things like more access to lower ticket prices, earlier swap times for those who purchase park hopper passes, more incentives for annual pass holders, like being able to enter the park in the afternoon without a reservation, along with some complimentary offerings like photo downloads, free parking if you are staying at a Disney resort. So if you're a Disney fan, this is something that you wanted to see. Josh DeMauro, he leads the park division at Disney. He said this is just the start of many changes coming to the company, but it does mark the first major change within the park division since Bob Iger has taken back over the company as CEO. So we'll see how this is going. We do know people are going to the parks. They're spending at the parks. Guggenheim anticipates a 13% growth rate once Disney reports earnings next month. We'll see how all of this is reflected.
Yahoo Finance's own Ali Canal breaking down everything entertainment business news for us. We appreciate it. Coming up, everyone, the rise in credit card interest rates. We're going to speak with an analyst from LendingTree next. Rate hikes by the Fed have sent the average credit interest rate surging to new highs. For Americans with paid balances, that may not be a concern, but for the millions that carry a balance month to month on a high APR credit card, those payments can feel excessive. For more on what you should do if you find yourself in that situation, let's go to LendingTree's Chief Credit Analyst, Matt Schultz. Great to have you here with us today. First, what should people do if they find themselves in a situation where we've got interest rates rising and they carry that month-to-month interest?
Well, the best thing that they can do, one of the best tools that they have in their arsenal against rising interest rates is a 0% balance transfer credit card. And it may seem counterintuitive to folks to get a new credit card as a way to fight credit card debt, but these cards are widely available, especially if you have good credit, and they can allow you to go a year, 15 months, up to 21 months without accruing any interest on that transferred balance. So while rates have gone up like crazy and it's a daunting time for anybody with credit card debt, a tool like a 0% balance transfer card is a really, really good option.
Matt, sorry, do we know what percentage of people who have credit cards do carry a balance and do end up paying interest?
It's a little over half. It's something like 55% of active credit card accounts carry a balance on a regular basis. And the latest Fed data that just came out the other day showed that for accounts that are carrying a balance, that are accruing interest, the average interest rate is 20.4%. And that's a jump of 2 full percentage points from last quarter. And it's the highest number since the Fed began tracking this way back in 1994. So it's a really, really tough time to have credit card debt.
Matt, what's your best advice? If I have 5 Gs on a credit card with an interest rate of almost 23%, how do I bring that down?
Yeah, it's really about trying to control that interest rate, whether it's through a 0% balance transfer credit card, a personal loan. And another thing that people can do that they may not know about is that they can call their credit card issuer and ask them to lower their rate. We did a report in 2022 that showed that 70% of folks who asked their credit card issuer for a lower APR got one. But the problem is that far too few people ever ask. So it's just so important. It can be really daunting.
Matt, let me jump in here. I've never heard that before. You can call up your credit card company and just get that rate lowered. How do you negotiate something like that?
Yeah, no, I get that reaction all the time when I tell people that. And really, in some cases, it's a matter of just calling and asking. But really, the best way to do it is to come with a little ammunition in the form of offers that you might have received in your snail mail or your email or seen at sites like LendingTree, calling them up and saying, hey, I've been a good customer of yours for a while now. I've never missed a payment, but my APR now is 23, 24%. I just got offered a rate of 18, 19%. Can you match it? And the credit card marketplace is so competitive that chances are, if you've been a good customer, they're going to at least listen to you and work with you.
For households who are trying to monitor how they're spending their cash, where might you say for a credit card kind of increased usage at this point in time too, what other tips they can take to best kind of monitor their spending and really take hold of that, knowing that they might have to put a few more things on credit as everything else continues to be increasingly expensive right now?
Yeah, really one of the best things that people can do is reassess the budget that they have, because a lot of people may not have reviewed that budget in 3 or 6 months. And if they haven't, a lot of the assumptions that they made about expenses have probably been blown out of the water because of inflation. And if all of those assumptions are incorrect, at the end of the month, you're going to end up having less income to put towards things like paying down high interest credit card debt. So that's really the place to start, is making sure that your budget is up to date and that you know exactly how much is coming in and out of your household on each given month. And then you can prioritize where more of that money goes.
Do you think we could outlast a shallow recession or even a mild recession without seeing some type of credit crisis, hopefully?
I do think it's entirely possible. The resilience that Americans have shown has been really pretty remarkable. I mean, even now, with nearly record credit card debt, record interest rates, delinquencies are still near historic lows. They're climbing, but they're still really, really low. And I think that as long as we don't see the bottom fall out when it comes to the job market, I do think that there's a chance that people may weather this, because credit card debt is just kind of what we do in this country. We always have it. It tends to grow. And people, even through the pandemic, even through some really weird economic times, have generally done a pretty good job of handling it to this point.
Matt, thanks so much. Good tips in here for folks. Matt Schultz, a LendingTree Chief Credit Analyst. Appreciate it.
Thank you.
Well, the World Economic Forum, ahead of its meeting in Davos next week, is out with its Global Risks Report for 2023 and explores some of the most severe risks we may face over the next decade, which, according to WEF, will be characterized by environmental and societal crises driven by geopolitical and economic trends. Topping the list for global risk over the next 2 years, the cost of living crisis, and then for the next decade, climate change marked by biodiversity loss and ecosystem collapse. And Saz and I are paying particular attention to this because we will be going to Davos next week, and this will be definitely part of the conversation there. And there's always there's sort of multi-track conversations there. You have the discussion of these big, heady ideas and how various global players can solve them, and the people there are a combination of world leaders and corporate leaders and nonprofits. Then you have the sort of what's going on in the economy right now, which is a big topic of conversation. And then you have the various individual interests, if you will, deal making, networking, and the like that go on there.
Yeah, some of these risks here are just, eye-opening. Not surprising, I should say, but wow, to your point, first one, short-term cost of living crisis. Next, natural disasters and extreme weather events, short-term risk. We've seen a lot of storm activity, of course, pick up in this country the past 2 years. And number three, geoeconomic confrontation. But to your point, Julie, so these will be some of the topics that we'll be talking about with all the executives we have on tap next week at Yahoo Finance while we're on the ground there. But also general observations too. Last spring when we went, big presence for cryptocurrencies. A lot of huts, a lot of places down there, a lot of cryptocurrency executives. Are they still on the ground this year? If so, how many? What does that contingent look like? What is their presence? What is their future outlook for this crypto industry in the wake of FTX? Very, very important there as well. And of course, I think inflation and the outlook for interest rates will be top of mind with every single person we talk to.
It's interesting, some of the topics that have also now made their way into the survey that goes ahead of World Economic Forum, talking about some increasing efforts around artificial intelligence, or at least risk mitigation around artificial intelligence. That's been kind of present conversation with ChatGPT most recently, and making its way into the household kind of dinner table conversation even. But you think about space exploitation, cross-border cyber attacks, misinformation, all of this now making its way into the survey. So it'll be interesting to hear within each of those conversations and the interviews that are done on site by you guys, exactly where executives are ranking that within some of their own priorities too.
And it might be good to bring back up the state of the world's infrastructure in light of what we saw with Southwest, light of what we saw today with FAA. That discussion was really had about 2 or 3 years ago at the World Economic Forum. Didn't happen when we went last year, but should we be asking executives about this? What is the state of the global infrastructure in light of these attacks? And it's not just bridges and roads, it's software.
Yeah, definitely. And widespread cybercrime and cyber insecurity is also on this list, both as a short-term and longer-term risk. To bring it back to the cost of living crisis, I think that intersects with so many other themes we've talked about, including the inflation situation. And, when you think of Davos and these, in many cases, millionaire and billionaire executives who are there, who are sort of divorced from the day-to-day cost of living challenges that, we talk about people in the U.S. all the time paying more for eggs and everything. Forget about the U.S. What about the rest of the world, where cost of living is a matter of survival in many cases, and we have seen the cost of living go up.
And Fed rate hikes don't change that overnight, if at all.
Right.
This inflation stays with them.
Well, and also because you do still have the Russia-Ukraine war, for example. You do still have China sort of gradually reopening, and so all of that affecting food supplies around the world, still the ripple effects of that occurring. So there's going to be a lot to talk about next week.
Perhaps some of those millionaires and billionaires could benefit from the cost management household strategy of Cardi B. She was monitoring everything that is spent in her household.
Well, we'll ask about that.
They probably could, actually. Why don't we ask? That should be one of our questions for everyone. Do you subscribe to the School of Budget Management, the Cardi B School of Household Budget Management?
I just wrote that question down in my head. I'm going to put it to various executives that we're talking to. I can't give it away. No. All right, coming up, Yahoo Finance senior healthcare reporter Anjali Kamani has just landed from the big JP Morgan Healthcare Conference. We'll get her top takeaways from the key event next. And that's a wrap for the closely watched JP Morgan Healthcare Conference. Our senior healthcare reporter, Anjali Kamlani, is back from her time there and is here with the latest, starting with Moderna's COVID vaccine pricing. Anjali.
That's right. Moderna CEO revealed that they're going to price their COVID vaccine somewhere in the $110 to $130 range per dose. And that is pretty much on point with what Pfizer did mention. But it is a little bit over what we did hear previously from Moderna when they suggested it could be less than that in the $82 to $100 range. So we'll have to see this all coming, of course, as the vaccine companies look to be on the commercial market, that is with insurance paying, rather than going directly through the government. Now, I asked Moderna chairman Noubar Afeyan, who is also the CEO of Flagship Pioneering, what he thought about the pushback that has come in the form of a letter from Senator Bernie Sanders saying that this price is too high. Listen to what he had to say.
We agree vaccines are free. Governments ought to purchase them and provide them to prevent disease. I don't think we should conflate the pricing pressure on drugs with vaccines.
He went on to say that the discussion around vaccines and the pricing of them is more of an economic benefit, wherein the price of the vaccines is so much less than what a hospital visit, for example, could cost. So really interesting discussion there. We'll definitely have to see what the market feels about this, especially as we already see low uptake with free vaccines on the market. So stay tuned.
And Anjali, as we mentioned, you just got back from that JP Morgan Healthcare Conference. What were some of your takeaways? What were some of the themes, the common themes that we heard?
Well, like I was saying since yesterday, we definitely saw lower deal volume than before and smaller amounts for that matter. We've covered a few of those small, some of those smaller deals, but we also heard about CVS partnering with Carbon Health, which is interesting because that company really got their name through the pandemic, standing up test sites and really being a part of it. But now they look like they're more strategically aligned with what CVS is going for, which is more primary care in pharmacies. And that's something that we're seeing across retail, with more focus on what kind of services can be moved out of hospitals and out of doctors' offices and into a more public access setting. So that's one interesting one to watch. We also saw a lot of discussion about investment cooling and the industry being at a tipping point. I kept hearing that over and over again. So it's going to be really interesting to see what that means. They're, of course, facing some of the same headwinds that you mentioned earlier, with not only the war, but also inflation, recession, China, etc. So it really is an interesting first half to watch of the year. And maybe deals could pick up by the second half of the year, or it could continue in this cooling down episode. We know, of course, the last 2 years have been pretty hot for the sector. Meanwhile, also the conference itself, much quieter. Everyone kept commenting on how much quieter it was than previous years, including the virtual years, where some mentioned that it might be a little bit more productive for them than going back in person. So who knows what the fate of this conference is in the future.
Wow, really interesting there. Thanks so much. You know how I feel about being in person. Love it. Anjali, thank you. Coming up, we're checking in on the latest with the airlines following this morning's system outage. We will have the latest next. Flights across the U.S. have resumed this morning after the Federal Aviation Administration previously ordered all airlines to pause all domestic departures due to an outage in the FAA's Notice to Air Mission system. OAG Senior Aviation Analyst John Grant is joining us now. So, John, obviously that this could have happened at all is pretty alarming. What is the solidity, if you will, or the reliability of this system to begin with?
It's pretty good. I mean, we should never say it's a one-off event, but it's not happened for quite some time. And clearly it's a frustration for every airline and for every passenger who's turned up early at an airport and been unable to travel this morning. But perhaps more than anything, it shows that there needs to be more resilience in the systems and in the infrastructure for air services throughout the United States. It's an area that's been sorely lacking investment for probably 10 or 15 years now. So I know the FAA and the administration are conscious of the need to invest in this space.
Right. So who's responsible for that investment, and where will this kind of renew calls as there's going to be a Senate committee that seems prone to really investigate this at this point in reaction, but there have been issues in the past of some senators pushing back against FAA funding as well.
Well, ultimately, the airlines and ultimately the passengers going to pay for this. If it means that there are increased charges for navigation services that are passed to the airlines by the FAA, then that's a measure of recovery. But in the context of global aviation, navigation charges in the United States are almost zero. So compared to Europe, where airlines pay quite a lot to Eurocontrol and other pieces of airspace, such as in Russia, where navigation charges are outrageously high, it's been a pretty free run for the airlines. So I think this is probably going to be another piece of that need to rethink about air services, the infrastructure, the way they're administered in the United States, and particularly in the domestic market. It's fascinating to see what happened after the cyclone bomb. The FAA obviously demanding airlines to treat passengers with more care and attention. And now, of course, one of the FAA's major systems collapses and leaves the airline stranded for 6 or 7 hours, and now trying to pick up the pieces.
John, we had a guest earlier on the show suggest that there aren't not enough qualified people running the FAA. Would you agree with that?
I would say that the whole industry through the pandemic has lost skilled people in all areas. And not just in the United States. This is a global issue. We've lost licensed engineers, we've lost pilots, we've lost air traffic controllers who've all taken voluntary redundancy, retirement, whatever it happens to be. And those skill sets are missing, and it does put pressure on the whole system and the whole industry. It was interesting to observe last week that the CEO of Delta Airlines was saying, they've re-employed 30,000 employees through the pandemic, and the experiences they've had in the last month in terms of weather, disruption, delays. It's the first time many people will have faced those experiences, those operational issues. And only when you've lived through that can you actually begin to understand what you can and cannot do and how these things work. So the whole industry is, once again, relearning and re-equipping for these moments when everything begins to go a little bit wrong.
For the past 5 years, and I guess in aggregate over that period of time, customers or passengers have had to really wrap their heads around what a revamp of certain aircrafts may look like, or issues around Boeing 737 MAX. They've had to wrap their heads around what a pilot shortage does in terms of impacting what their own customer experience is like. And now it comes to light that there's issues with even some of the systems that the FAA has and the amount of funding that have been invested in order to bring their systems and their technology up to speed. What really needs to be done going forward to assure passengers that there's a safe mechanism and safe procedural system that continues to be in place and invested in?
Well, the first thing to say is, and to reassure everyone, air travel is every year is safer and safer. And if you look at any of the metrics, then the improvements that are being made, not just in terms of safety, but in terms of carbon emissions and everything the industry is doing about sustainability points to it heading in the right direction. But there does need to be investment in these areas. And I think what we're going to see now is those airlines that have not invested are going to have to invest heavily. And that's the likes of perhaps Southwest, who are going to have to put more automated systems in place. And those airlines such as Delta Airlines, who consistently outperform every other US airline along with Hawaiian in terms of on-time performance, will reap the benefit of the actions and the investment they've taken in recent years. But, the industry is completely safe. The fact that as soon as these NOTAMs were no longer being issued, a ground stop was put in place. It de-risked any potential event occurring in the skies. And those aircraft that were in the skies already had their NOTAMs with them. So they were safe as well. It's inconvenient. It's a great news story, but in the context of this industry, there is no safer industry, I think, at the moment that is investing more and more in safety.
All right, really good words there and wisdom. OAG's Senior Aviation Analyst, John Grant. Appreciate the analysis and the insights. Thanks so much.
You're welcome. Take care.
You too. Coming up, everyone, Netflix tightening the strings on its salary transparency. We're going to discuss that on the other side of this short break. Welcome back, everyone. Time for Cut for Time. 3 stories, 1 minute each. We start with this today. Netflix now restricting some employees' access to view their coworkers' salary information. According to the Wall Street Journal, director-level executives at Netflix had the ability to look up colleagues' compensations as part of the company's pay transparency to its workforce here. We're keeping an eye on Netflix shares, but I mean, at the same time, it's really an internal decision that perhaps in that transparency, Netflix was, I think, within this broader tech industry that was really looking for more of that salary transparency and the removal of some of the the negotiations that really netted out in companies or the employees being able to compete elsewhere and go elsewhere and have those non-compete agreements as well, this could potentially be a huge move as well in the near term.
Yeah.
I don't know why the other companies that do this or have done this. I can't recall.
I don't know of other ones that have done this to this extent, but apparently it was that there were so many people making a certain level, that had a certain title, and the people were looking at other people with the same title and saying, well, I don't make what they make.
Yeah.
So I guess that's the downside.
All right. Asia's largest clothing retailer and owner of the Uniqlo fashion brand Fast Retailing will increase employee wages in Japan by as much as 40% to help workers fight rising inflation. Of course, good to see this. Now, I'm wondering how some of this company's competitors respond in the coming quarters. You would think they would have to raise wages too.
Well, and it's about Japan specifically, because even the Prime Minister, Fumio Kishida, has been calling for companies to raise wages. So there, it's almost a national political issue, and not just sort of competitive wages, et cetera.
Yeah, some of the core inflation that we'd seen in Japan, based on recent data, has been at an 8-year high. And so I think continuing to give your employees some access to higher wages in order to combat that. I mean, I think that's a good signal for the company, perhaps helps them retain some of that employee base too.
The average pay in Japan on an annual basis, $39,711 in 2021. The OECD average, over $51,000. And it hasn't changed much in the past few decades. And say goodbye to new gas stoves. The U.S. Consumer Product Safety Commission is reviewing gas stoves and range tops as new studies have shown respiratory and certain cancer risks linked to their use. Any regulations made would apply to new products. So if you have a gas stove, you don't have to get rid of your gas stove, but there might be regulations going forward. We had a hot debate on this topic in our morning meeting, gas versus electric.
Yeah, Yahoo Finance chief economist really weighed in on this one and decided to also become Yahoo Finance's chief gas stove ambassador, because I think at the end of the day, many of us do have that in our New York City apartments here, but there's more of an environmental play, I believe, as well. On the
it puts out a lot of emissions that you're breathing in inside your apartment. I have recently become a convert, not just to electric, but induction specifically, which is a chemical reaction between the vessel that you're using to cook and the burner. I'm a big fan, but it's not as common in the U.S.
So what's better for the planet? Or what's better for cooking, actually? Is it gas?
I really like induction because it heats up quickly and you do have a high degree of control. But I don't know. But it's better for the planet. Electric is
I have electric.
Electric is better for the planet.
I wanted to just trigger.
Your trigger grill.
I just want to debate you a little bit.
Electric is better for emissions.
Interesting.
Yes.
All right. Gas is good for the food you eat. All right.
Although it depends on the source of your electricity. That's very complicated. All right, let's take a look at markets here, shall we? And some of the trending tickers that we've been watching have been quite interesting. Stocks are hanging on to the gains, although the Dow just barely. But we've noticed some reversals in some of the key stocks that we've been watching here. You flagged, Saz, Bed Bath & Beyond and Party City.
Yeah, pity party over there at Party City. I can't take credit for that line. It's our producer Mike rocking that one. Big reversal. Top ticker on our site is a stock that you see it is about 45 cents right now. Stock in the pre-market was up close to 50%. It was down about 5% just minutes ago. So really wild reversal there. Bed Bath & Beyond gains have strengthened throughout the session for that. Was up almost 50%. Guys, these are retailers. They're on the verge of going out of business. We will warn you again, if you are watching these moves, these are speculative plays on fundamentally challenged companies. So just buyer beware.
And WWE also
WWE
switching direction.
Exactly. We're seeing, actually, it was higher up on our list, but as of right now, it looks like it's up by down by about 1.5% for WWE. And that, of course, on the shakeup, but also at the same time, who they're going to sell to potentially.
Getting body slammed on the session.
Yeah.
Ah, very nice. All right, that does it for the three of us. Rochelle Akubo is going to take you through the next hour of trading. She's going to do a deeper dive into tech infrastructure following that airline system outage with an assistant professor from Harvard. That says we still see delays. My husband was supposed to take off at 11 today. Looks like it might be 1 o'clock.
Welcome to Yahoo Finance. It's 11 a.m. on the East Coast and 8 a.m. on the West. I'm Rochelle Akufo. Here's a look at what we're watching this morning. Wheels up. Domestic departures resume across the United States after all takeoffs were grounded due to a flight safety system failure. President Biden has called for a, quote, full investigation after the 3-hour incident. And riding the wave, the bear market bounce catching short sellers off guard and giving renewed life to the meme trade. But are we set for a reality check with inflation data and bank results on the docket this week? Plus, build it and they will come. It seems like Apple wants to bring everything in-house these days. After moving away from the likes of Intel, now it seems Broadcom and even Samsung could be done away with as well. We'll talk tech this hour. But first, let's take a look at how the major indices are faring. We see the Dow there near the lows of the day, but only off slightly there, just up about 11 points, about 11.5 points. We see the S&P there also near the lows of the day, up about 0.25%, about 10 points. And the tech-heavy Nasdaq there up about 0.5% on the day, seeing some selling in this morning, but still in positive territory for now. Let's also take a look at what we're seeing with the Treasury market as well. Always like to keep a track of that. We're seeing that, especially the short term there, the 5-year down about just 1%, the 10-year down about 1.2%, and the 30-year down about 1.7% as well. All right, well, we're starting this hour with our eyes to the skies. The airline industry was dealt a blow this morning when the Federal Aviation Administration paused flights across the U.S. Now, after the FAA suffered an outage of the system responsible for sending essential aviation information to pilots. Domestic takeoffs have since resumed. Now, there's only been a few times in the US where flights on a mass scale have been grounded, including in 1981 when labor unrest led to a massive strike. That brought about 35% of the nation's commercial flights to a halt. But it wasn't until September 11th of 2001 when the US aviation for the first time in history, put a ground stop on all traffic. We're here to discuss the latest on this issue and, of course, all things digital infrastructure is Frank Nagel, Harvard Business School Assistant Professor of Business Administration. Good to see you here. So obviously now flights are starting to resume. We're seeing this domino effect starting to resume. But put this in context for us. How significant is a failure on this scale?
Thanks, Rochelle. It's great to be here with you. And it is pretty significant, but thankfully they were able to recover and get the systems back up and running fairly quickly. So the latest numbers I saw were over 5,000 flights delayed, nearly 1,000 flights canceled. There you go, up to 6,000 now flights delayed. And the trick with this, of course, is that it's a complex structure and a complex system. And so, you know, it's not just about those flights, but that were delayed during the outage of the system. But instead, there's going to be delays all day. And hopefully we'll be able to catch up. Obviously, you know, the airline industry we saw just a week or two ago dealing with these types of issues, and in that case, a large snowstorm. Some airlines did better than others. And so I think we'll see the same type of thing today as the, you know, various airlines try to get back to their, you know, regularly scheduled flights.
And thankfully, this didn't happen bang smack in the middle of the holiday season. That would have been a nightmare. But I want to ask you about this system, this NOTAM system, Notice to Air Missions. And what it essentially does is warns pilots about issues, whether in the sky, hazards in the sky, hazards on the ground as well. What questions does this raise about the safety of the system and perhaps the need for some sort of subsequent backup systems as well?
Yeah, so one of the good things about these types of critical infrastructure, not just airlines, or you know, air traffic, but all sorts of systems that we rely on for these types of critical tasks, they do have backups of various types, right? And so, indeed, this particular system, you know, it tells pilots about various kind of things they need to be worried about: closed runways at airports, or obstacles near airfields, even hazards in the air. So if there's, you know, NASA's launching a rocket, or if there's an air show somewhere, so it's important information for the pilots to know. Now, this is certainly different than things like the air traffic control system that actually keeps track of all the planes that are in the air and tells them where to go and when to, you know, how to make sure they don't run into each other. So a different, you know, this isn't the kind of the primary, most important system, but it is a very important system to letting pilots know what they have to worry about. And so, you know, from that perspective, I think it was very good news that they were able to get this back up and running fairly quickly. I haven't seen any details detailed information about what the issue was. It doesn't, at least at the moment, there's no evidence of it being a cyber attack or something more nefarious like that. Usually these types of things where somebody put an update into the system and it didn't play nicely with the existing, the existing code or the existing system, and so things went haywire. That may well be the case, but we'll have to kind of wait and see exactly what happened. But indeed, as you said, kind of having backups and redundancies for these types of critical infrastructure is obviously becoming increasingly important as we face both, human-made bugs and things like that, but also potential cyber attacks from adversaries.
And as you mentioned there, I mean, we saw from the White House press secretary, she tweeted that there's no evidence of a cyber attack at this point. President Biden aware of the situation and expecting the Department of Transportation to conduct a full investigation into the causes. But when you look at this sort of infrastructure that's behind this, is this something that is in need of an overhaul, or should we be more forward thinking from this point?
Yeah, so I think absolutely is the answer. Different types of infrastructure. We can think about the energy grid, or in this case, the airline systems, or even things like the financial system and the backbones of the financial system and how that operates. The problem is that a lot of this technology was developed, 40, 50 years ago, and it's still, in some cases, it's maintained fairly well. But the number of folks that actually understand how the system works is slowly declining. People are retiring, new folks come into these organizations and don't know exactly how the old systems work. I actually, in my old consulting days, worked on some of the federal tax systems with the IRS. We actually had to pull some people out of retirement to help update the systems because none of the folks that were there knew kind of the intricacies of the operation. So as we kind of shift from some of the older, critical infrastructure to a more heavily digital-based infrastructure that's increasingly built on kind of open technologies, the types of updates and the maintenance and everything like that is only going to become even more important than it used to be. And when we think about air traffic and all these types of critical infrastructure, usually they're built to be fail safe, and so that if they fail into a kind of a safe mode, so that we have kind of what happened today, that flights are grounded rather than people being up in the air and not knowing what's going on and not knowing some of the risks that they face. So that's a good thing, but we have to think more about how we implement the maintenance and the updates and really overhaul the infrastructure. And I know there's an FAA infrastructure bill that's working its way through Congress at the moment that would hopefully help to address this particular type of problem in the future.
We're certainly putting it in the spotlight. We'll see how fast that bill goes from this point. A big thank you there to Frank Nagel, Harvard Business School Assistant Professor of Business Administration. Thank you for joining me. All right, well, let's pivot now to the market action where the meme trade is gaining some steam. Here to break down all the action is Yahoo Finance's Inez Ferrer. And there's a lot of movement this morning.
Oh, yeah, tons of movement, especially with BBBY, Bed Bath & Beyond. I'm going to pull that up on our interactive board right here so you can see it's up more than 40%. It's actually up for the last 3 days. I'm right here. You can see Bed Bath & Beyond on the upper left corner, up 48% over the last 3 days. It's up 135%. A lot of speculation with this retailer. Last week, Bed Bath & Beyond lost almost half of its value. It's been in trouble. It reported a bad quarter, bigger loss than expected. It's exploring strategic options, including perhaps bankruptcy. It started another round of layoffs. So a lot of speculation with this stock that has been traditionally considered one of the meme stocks. I mean, you've got AMC and GME that are the flagship meme stocks, but Bed Bath & Beyond certainly throughout all of last year has been a popular meme stock. There also could be speculation that the stock price is so low that perhaps it could be a target for acquisition. So that also helps to send the stock higher. Do want to point out on our trending ticker page, we have had Party City as the #1 trending ticker. Shares yesterday skyrocketed in pre-market. Those shares were up 50%. But take a look. Now it's down 4%. Quite a lot of volatility of what we've seen today with this company. It's in talks for a potential bankruptcy loan. Now, keep in mind, just because a company if it does go into bankruptcy, doesn't mean that necessarily it is the end of the company. Remember that Hertz went into Chapter 11 back in 2020, and it emerged from Chapter 11 as a stronger company. But what it does do initially to the stock price is it brings it down. So certainly, Rochelle, a lot of speculation is what we're seeing with these meme stocks.
And of course, not a rosy picture at all for bears and short trades on the markets right now. What can you tell us there?
Yeah, look, part of what you're seeing is also a short covering. So you have, I'm going to pull up BBBY is right now, short interest is incredibly high on this stock. It's 48% of the float. So that means that you've got the number of shares that have been sold short. That short interest is incredibly high. GME and AMC is 21% of the float. And just for comparison, usually U.S. stocks have about 5% of the float that has short interest. So incredibly high short interest on these stocks. And when you get these types of rallies, you have short coverings that only exacerbates the move to the upside. So part of what we're seeing with these stock movements is short covering. And with Party City, in fact, I was looking at a Reddit board from 5 months ago. These Redditors were predicting that Party City would be the next big squeeze. So certainly that's what they're watching out for right now.
See, we thought the Reddit crew was behind us, but here they are in full force. A big thank you there, Inez Ferre. All right, time now for our trending ticker. As shares of Tesla are in focus this morning. We see them moving to the upside following a report that the company is close to a preliminary deal to set up a factory in Indonesia. According to Bloomberg, the EV maker is looking to take advantage of the Southeast Asian nation's reserves of key battery metals. Now, the discussed plans would include multiple facilities serving different functions, including production and the supply chain. All right, coming up, the fallout continues. Attorneys for crypto exchange FTX are in bankruptcy court today in Delaware. We get the latest on that story next.
The public reasonably expects supervisors to require that banks understand and can appropriately manage their material risks, including the financial risks of climate change. But without explicit congressional legislation, it would be inappropriate for us to use our monetary policy or supervisory tools, for example, to promote a greener economy or to achieve other climate-based goals. We are not, and we will not be, a climate policy maker.
That was Fed Chair Jerome Powell there yesterday with remarks on the Fed's clear role in regards to climate change, a blow to environmental activists who have pushed central banks to take steps to restrict lending to energy companies. All this as ESG funds took a hit the past year with no relief in sight. For more on the road ahead for ESG, we have to discuss with us Bill Davis, Stance Capital founding partner and portfolio manager. Thank you for joining me this morning. So obviously we've seen some of these ESG funds especially getting beaten up. In fact, 10 of the largest ESG funds by assets over the past year underperformed the S&P. I believe only 8 underperformed the S&P. But how hard of a sell is this right now, investing in ESG?
Well, first, Rochelle, thanks for having me on. I think I don't think it's a hard sell at all. I mean, to be sure, I think the industry faces some headwinds, some of which I think are a little bit self-inflicted. For example, if you think about the S&P 500, it's a market cap weighted index. I think entering 2022, 6 or 7 companies accounted for 25% of the index. I think now with declines in a lot of FANG stocks, that's down to maybe 10 companies accounting for that. But, you know, because it's mega cap concentrated and because you had stocks like Apple down, I think 27% last year, Amazon 50%, Microsoft 29%, and all the rest of the FANG stocks kind of were averaged, I think they averaged 50% declines. It's not surprising to see a lot of US ESG managers who happen to be growth oriented taking a big hit because they're simply overweight a sector of the economy that, you know, disproportionately underperformed in 2022. So I think that is part of what has happened, and that's a big part of what's happened. I think that's also part of the challenge moving forward, because in a rising rate environment, I don't think growth stocks is necessarily the place that a lot of investors want to be making big bets right now. And that is kind of, you know, sort of self-inflicted headwinds. I think that there is a second set of headwinds that really is not a grassroots initiative. It's basically, you know, frankly, a political ploy funded by a web of dark money or a network of dark money funders that is seeking to kind of make ESG or values aligned investing a political wedge issue. I think it's doomed to fail for a variety of reasons.
And so to that point, then, obviously, it has become something of a political football, some critics accusing it of being woke investing if you invest in ESG. Do you expect that to perhaps get worse now that you have a Republican-controlled House? How do you expect that, especially the policy surrounding it, to continue?
I think it's mostly a bunch of noise. I mean, interestingly, most Americans don't have any idea what ESG is. Most Americans, by the way, aren't stock market investors. But the more they get educated that this is really a means of managing risk, and the idea that capitalism is going to be sustainable in order to continue to be capitalism, I think that you're going to find that, number one, the more talk there is, the more confusion there is. And secondly, the more people do get to understand what's actually going on, the more they're going to want to sign up for it. So I don't actually think that the political headwinds are going to amount to much other than just simply a lot of noise.
And as you look at the demographics, you are seeing that younger investors in particular prioritizing some of this ESG investing. What sort of returns, though, can we expect then in 2023?
Well, before we get to young people as investors, they're also employees, right? So something like 60% of the US workforce is going to be made up by millennials and Gen Zers, I think as early as 2025, so 3 years from now. These employees are also consumers, and what they want is they want sustainability. They are for things like diversity, inclusion, and social equity. This is what they want. So this idea that companies are being led around by the BlackRocks of the world is really completely missing the point that out of enlightened self-interest, many major corporations have recognized that this is really good for business. And, climate risk is an existential systemic risk that's going to affect all businesses and it's going to affect all of humanity. And so from a fund management perspective, being on the right side of that story and investing in companies who are doing a better job of mitigating these risks is important to younger investors, but it's becoming more important to all investors, whether they're big institutions or smaller companies. And just to add something to what you said about the performance of the industry as a whole, in 2022, Stance Capital actually outperformed the S&P on a gross basis by over 600 basis points. We now have a 9-year track record in our U.S. large cap strategy, which includes over 200 basis points of annualized outperformance with less risk. So the point is that if ESG is done properly, it actually minimizes risk and invests in companies who are better positioned to weather climate-related storms in a figurative sense, but I suppose a literal sense too. And it actually positions, I think, companies to be on the right side of history with employees and other stakeholders.
Definitely keeping in mind that stance, ESG, that we're taking a look at there. A big thank you to Bill Davis there, Stance Capital founding partner and portfolio manager, for joining us this morning. Right, well, attorneys for crypto exchange FTX are in bankruptcy court today in Delaware. Now, they're arguing over disclosure of customer names that they want to keep secret for at least 6 months. The company also revealing recovery of more assets. Yahoo Finance legal correspondent Alexis Keenan has the latest. Hey, Alexis.
Hi, Rochelle. Yeah, so we've been listening in on this bankruptcy proceeding, which should go a good part of today. There are a lot of motions at stake. But one of the big revelations right off the top was that FTX's lawyers said that they had found $5 billion in liquid assets. That includes cash, crypto, and securities, they said. This is in addition to the $1 billion that the company had previously said it recovered. They also said they found some illiquid assets. This is all good news, of course, for creditors. Those include customers who are owed collectively $8 billion. And also that figure does not include the $425 million that is currently in the custody of Bahamas regulators there. Now, the lawyers also in court arguing over the release of FTX's customer names and their identities. Now, usually in a bankruptcy proceeding, the names of the creditors, the addresses, as well as their emails, those are all usually handed over and made public. But the FTX lawyers are saying that that shouldn't happen. Now, the opponents to this measure, those are news organizations, including the New York Times, Bloomberg, and others, as well as the U.S. trustee. They said this information should, as usual, be made public. Now, FTX, for its part, says it wants 6 months in order to keep these names quiet while it handles the affairs. They say that releasing the names opens up the possibility that other crypto platforms could poach these customers, and in turn, that would devalue FTX in its reorganization or in its potential eventual sale to a buyer. So that's what's going on in the court right now. We don't know if we'll get a ruling on that particular issue, but we'll be back in the hearing listening and bringing you the latest this afternoon.
All right, thank you for those updates. Alexis Keenan there for us. All right, coming up, in-house production. After moving away from the likes of Intel, now it seems Broadcom and even Samsung could be done away with, as Apple plans to make more key components itself. We'll take a deep dive next. Apple hinting at its all-in-one future with recent moves to bring more manufacturing in-house. Now, the tech giant developing its own versions of everything from wireless chips to displays. The move's likely part of CEO Tim Cook's plans for the company's future. Yahoo Finance's Dan Howley has more. And Dan, we've been following this. We were just talking about the chips yesterday.
That's right, Rochelle. This is, just on the back of the announcement or the news that Apple is likely going to ditch Broadcom as well as Qualcomm in the upcoming iPhones that they'll launch. They're now reportedly looking at building out their own display technologies. Now, it's important to note that they're not going to actually build the displays. They're going to be designing them. But this is still a huge blow to the likes of LG and Samsung, which currently do all of that for Apple. What this really means is that, as you said, they're trying to bring more and more of the design process for their technologies underneath their own roof. We already have the chips that they offer, the M1, M2, M1 Pro, M1 Max. Those you can find in the Mac and MacBook line of products. They already offer their A15 chips that we have in the current iPhones. The A line of chips has been going on for some time. They're looking at those modems. They're looking at those Bluetooth chips. And now it's the displays. The displays in particular, however, are expected to start on the Apple Watch. And that's pretty much a smaller platform for them to get started on. According to this report, they're going to be using a type of technology called micro LED. They currently use OLED technology on both their smartwatches and their smartphones. That's really just a great kind of tech overall. My TV's got it, so it's awesome. Basically means better colors as well as deeper blacks. LCD technology, the kind that you have, or regular LED technology that you have on your average laptop display, is not as good as far as colors go, but is brighter. Now, this micro LED technology kind of takes the best of both worlds. It's bright and offers those great colors. So it'll be interesting to see what this looks like on a watch and a smartphone down the line. But, as I said, this is all part of that strategy of trying to bring everything in-house. Tim Cook is the architect of their supply chain as we see it now. He started laying that out prior to being CEO. And so we can expect him to continue to make moves like this. It just depends on where else we could see it.
Absolutely. We'll be keeping an eye on that. A big thanks, Dan Howley, there reporting for us. All right, let's now turn to a wider look at the tech space. The sector could be nearing the end of its COVID-induced overextension hangover and might be looking to return to performance-driven positive trends. Joining us with more is Erica Clower, Technology Equity Portfolio Manager at Jennison Associates. Good to see you, Erica. So in terms of this hangover, because of COVID, because of constrained supply chains, as we sort of see these things the wrinkles start to come out, what are you looking at in terms of your expectations for this year?
Well, thanks for having me. At Jennison, we are, I would say, cautiously optimistic. We've made our way through a lot of difficult times coming through this COVID hangover, as you mentioned. We've also seen a lot of bubbles pop with regards to things like NFTs, cryptocurrencies. Many of the valuations of the highest priced technology companies have come in significantly. So we've made our way through a lot of difficulties, and estimates have come down to more reasonable expectations. At the same time, there are still some near-term headwinds associated with things like the strong dollar and also some of the regulatory problems that we are facing with regards to shipping products to China and strained relationships with that country. Having said all of this, at Jennison, we're really looking out over the next 3 to 5 years, and we see many different large vertical markets that are still in very early innings of growth, things like 5G, autonomous driving, artificial intelligence, that we think are going to push the technology sector higher.
So let's break some of that down. Let's start with, say, the likes of Apple, bringing more of their development and design in-house. Can we expect those sort of moves as really sort of after that wake-up call about perhaps diversifying some of their supply chains when we did see the lockdowns in China and a lot of companies were like, well, what do we do now?
I think we will continue to see companies diversifying their supply chain to reduce their dependence on one single source supplier. And so for those companies that are supplying some commodities, I think that the environment will be more difficult. However, for those companies that have sole source, large barriers to entry to compete with their products, I think those companies will relatively be better positioned. Fortunately, many of those companies are US based, whether they're software companies or hardware companies. There's a lot to choose from.
I also want to talk to you. You mentioned EVs there. Obviously, Tesla has some of its own issues given what's happened with Elon Musk and Twitter. But then as we look at the performance of EVs, what do you like in that space? And which ones do you think are going to be struggling this year?
So our team at Jennison really looks to the early innings of electric vehicle adoption. And so we think that there's a long runway for growth. And I think that what we're really looking for is more the components within the electric vehicles, the semiconductors, the software suppliers that can really enable the next generation of electric vehicles and also autonomous vehicles. And at the top of that list is NVIDIA. NVIDIA's stock has come down quite a bit from its high. It's rebounded a bit as people are looking towards its dominance, not only in the artificial intelligence area, but its newer entry into enabling autonomous vehicles themselves.
And you mentioned a couple of multi-billion areas of opportunity. You mentioned autonomous driving, robotics, vehicle electrification, artificial intelligence, but also healthcare as you look longer term as well. What do you like there?
So healthcare is such an interesting area for us here. You know, our team at Jennison is really looking at things like the aging population and how we can service a aging population, not only in terms of within the doctor network and the hospital network, but also home health care. So digital health is something that interests us quite a bit. Companies that are enabling remote health monitoring are very, very interesting to us right now. And then, of course, within the hospital itself, robotics are coming more and more into play and providing patients with very effective treatments with a little more, with fewer human error factors.
And obviously, as these innovations continue to grow, you're going to need people working in these industries, but we're also at the same time seeing deglobalization. How is that going to impact sort of the pace of innovation and what this means for some of these tech stocks?
So that's a great question. The deglobalization is probably, in my opinion, the biggest risk to the technology sector in the short and medium term, because companies are having to not only look at their supply chain and figure out that perhaps the one area where they were manufacturing, which was the lowest cost region for them, is just not a risk properly adjusted strategy. So companies are duplicating their manufacturing efforts. And by definition, that is inflationary, and it also is disruptive. Also, at the same time of deglobalization, we're seeing many more signs, particularly in China, of companies wanting to insource, just like Apple is, more and more of their own products from domestic suppliers, from Chinese suppliers. So those are areas that are inflationary by nature, the pressure margins in the short and the medium term. So that's something that we have a very close eye to, and I think is something that's definitely worth watching.
And we certainly don't hear enough about that. So I'm glad you highlighted that. Erica Clower there, Technology Equity Portfolio Manager at Jennison Associates. Thanks so much. All right, coming up, pushing ahead, stocks have seemed relatively unfazed despite a raft of hawkish Fed speak of late. Governor Michelle Bowman adding her voice most recently. We'll discuss the impact of tightening talk on your investments next. Healthy banks, financially strong households, and attractive rates contributed to a surge in the use of credit in 2022. But can a hawkish Fed get borrowing under control, or will it lead to higher inflation down the road? We're here to discuss this. Fed guy, blogger, and monetary macro CIO Joseph Wang. So good to see you, Joseph. So what are your thoughts on this, on how much this is going to end up fueling inflation?
Hi, Rochelle. Thanks for inviting me. And you make a really good point. We're having a tremendous credit boom here in the banking sector. So just for some context, usually the banking sector creates about $400 billion of loans a year. But last year, the banking sector created $1.2 trillion worth of loans. So there's a tremendous credit boom happening. So what that means is that the households, the economy has more money to spend, and that means more demand. And like you suggested, that is helping to fuel inflation. If you think back about what happened last year, prices are going higher everywhere. And part of the reason for that is because people have money to spend. And that's because banks are creating money. Now, the question is whether or not the Fed, by hiking interest rates aggressively, will be able to tamp down on that bank credit creation. Now, that's a really hard question to answer. Now, you'd think that with higher interest rates, there'd be less credit creation. But the funny thing is, when you actually look at the data, credit creation has been pretty strong all throughout last year. Now, it's slowed down a little bit, but it's been pretty strong. And that stands in stark contrast to what we've been seeing for the past 10 years. I think it's worth noting that when you're thinking about credit creation, it's really not just about interest rates, but there are other factors as well. For example, the willingness of banks to lend and the willingness and capacity for borrowers to borrow. Now, we're in a very different context now compared to, say, right after the great financial crisis. Our households, extremely strong. Balance sheets, net worth, among the highest ever. Job market is strong. Banks are healthy. So there's a lot of willingness and capability to lend. So I'm not sure that rates where they are right now is going to be able to slow the economy, slow the banking sector down sufficiently to get where the Fed wants it to be. So that's something we're going to figure out in the coming months.
I mean, as we start to look at some of the cracks, I mean, take, for example, Wells Fargo, which, the number one player in mortgage, is starting to now pull back from that. What should we read into that as we look at the tea leaves as to what that might mean going forward and how banks might start acting this year?
Yeah, so Wells Fargo's, it's hard to look at just one individual bank to generalize the story. As we know, Wells Fargo's has been in some turmoil over the past few years. When you're talking about mortgage lending specifically, though, I think it's important to bear in mind that only about half the mortgages are made by banks. There's been a huge change in the mortgage industries in the last 10 years. Most mortgages are actually made by non-bank lenders now. So if you zoom out, though, just look beyond mortgages, you have C&I loans, commercial loans, you have commercial real estate loans, you have, let's say, credit cards and things like that. That's all growing. So I would expect some slowing in residential mortgages, although that's not really apparent in the data yet in terms of quantities. But there are other credit areas that continue to grow strongly.
And which are the ones that you're seeing that are growing strongly?
All of them, actually. So if you break down the Fed has weekly bank data, and it breaks it down. It's very timely, so it's every week, and it breaks it down by different categories. And all categories of loans continue to grow. Now, they've moderated slightly over the past month, but they still continue to grow at rates that are above what you would expect before 2020. So before 2020, you'd say maybe loans would grow at an annual rate about 5 or 6%. They're still growing at about 9% annual rates these days. So, and that's after all the rate hikes we've seen so far. So the rate hikes are working a little, but probably not to the extent that the Fed needs it to slow down to.
And as you mentioned, if households are still strong, although we have seen more households dipping into their savings for some of these essentials, how do you break this cycle then if this is fueling inflation and it doesn't seem to be working in that regard?
That's a hard question. So from the Fed's perspective, I'm thinking that they would just kind of continue to do what they're doing. Well, the thing is that that's the only tool they have to raise interest rates and try to slow down credit creation. Now, it is working. It's just not working as effectively as I think people would expect. I mean, rates are maybe going to be 5% by the middle of this year. But again, that's not the only thing that matters. If you're a borrower, you have to take into account a lot of other factors as well. If you look at the labor market, for example, wages are growing strongly, unemployment is low. If people have confidence that they can keep their job and they'll have healthy wage gains, maybe those interest rates are not as scary as they might be in a context where labor market is weaker. And by the same token, if you're a bank looking to lend at someone, you see people, households having strong wage gains. You see them having a lot of equity in their homes, maybe fatter 401k portfolios, not as fat as it was earlier last year, but still comfortably above the pre-COVID levels. You might be more willing to lend to them as well.
Indeed, we'll be keeping an eye on that, especially as we sort of track what we see with potential recession fears as well. Fed Guy blogger and Monetary Macro CIO Joseph Wang, thank you so much for joining us this morning. All right, coming up, the Inflation Reduction Act could bring down the price of certain drugs. That story and more after the break. New year, new financial goals. As you collect your end-of-year bonus or pay boost, how can you make the most of these financial windfalls? Buckingham Advisors certified financial planner Nicole Sturbridge joins us now for our Financing Our Future segment, brought to you by Synchrony Bank Savings. Good to see you. So yes, when people first get that lump sum, it could be like herding cats trying to figure out as all your bills and your loans sort of calling for your attention. Where should people start?
Thank you for having me. You're exactly right. It really is sometimes a struggle to stop and think about what your plan is. And so that's really the first suggestion, is to set a plan. Really sit down and think about what your goals are and what your current needs are with regard to that bonus. And setting that plan will really help structure and strategize that, so that way you don't inadvertently spend some of those funds on something that wouldn't matter as much in a week or a month. So start looking at the structure for your short-term goals and maybe some of the the areas that you really need to focus on. So this could be something like adding to an emergency fund, making sure that's at a big enough level. Or if you do have some sort of high interest debt like credit card debt, those could be initial suggestions to focus on. Then we look at areas that you would get a benefit from contributing to now. So maybe it's making sure you're getting your match on your employer retirement plan, or an area where you could get a tax deduction now. Then we could look a little farther out and say, are there areas there's a longer term goal that you could get a benefit from having compound growth in the future? Really starting there as a structure is important. Then looking at the future and saying, where do we really need to focus, and having all of those ducks in a row before you actually start employing those funds.
So in terms of perhaps the share of the money then, how should you really apportion it out when you're trying to sort of do things like build the emergency fund and trying to pay off some of these higher interest loans?
I think that's a great question, because once we've laid out that plan and you kind of identify all of those big pieces, it can really help structure that. So looking at those short-term pieces first, I think is really important, and making sure we're getting to that area. A lot of people suggest maybe a 3-month goal for your emergency fund and making sure it's at least at that level. I think it really is dependent on your specific situation, your job structure, your income structure, taking that into consideration on if you need to be a little bit higher than that 3 months, but starting there and then identifying where those other goals would be and appropriating that. So if we can, by any chance, balance the approach there, I think that's the most helpful. And balancing, addressing those short-term goals while also sticking something away for the future is really important. And then we also add that balance with having a fun component with this, because you've worked hard, you've gotten this bonus because of all of the hard work you have. Balance is important in life as it is in finances. And so if you can kind of put a reasonable amount towards something that would be more of a fun expense, I think that's important. And it also helps us from maybe letting that get out of control too much and spending more than you would initially plan to on that fun expense, by if you just set that aside and go ahead and do something for yourself.
I mean, it's tough. Like, after the few years we've had, people are very much in still treat yourself mode. So what are some of the biggest mistakes you see people made when they do come into like an extra bump up in pay or a lump sum of money?
I think that's exactly right. We've been, for so many years, essentially not able to do some of these fun things. So that immediate reaction is to, pick that item and just go for it. And that's not always a bad thing. It's really just taking a breath and a pause ahead of that to say, is there anything else that I really financially should tackle first, and then providing that balance? It's great to have that goal and do that fun thing. And maybe you set up a structure that you'll get there over the next year. So it's part of this bonus that goes toward that, and part of the bonus that goes toward more of the things that add to your financial security and your financial future. And so just structuring so you get that benefit of moving toward that fun goal at the same time of having that balanced picture overall. And the other suggestion I would say is, if we can set it aside somewhere that you don't always see it, that may be helpful. So maybe that's setting it your emergency fund or this fund for that fun expense that you want to create in a separate account so that it's not quite as easily accessible. Or if it's something that's maybe even at a different bank, so that when you're opening that app or you're opening your web page to look at your bank accounts, you don't immediately see it, and it's just a little bit harder to spend.
Well, there you go. It's that high-tech version of putting your credit card in an ice cube and sticking it in the freezer. A little harder to get to, so that you get a little bit of, financial responsibility. A big thank you to Buckingham Advisors Certified Financial Planner, Nicole Sturbridge. Thanks so much. All right, turning now to the latest headlines around COVID-19. The Biden administration extending its COVID-19 emergency declaration, citing the spread of more transmissible variants. Joining us now with more is Yahoo Finance's Anjali Kemlani. Anjali, what's the latest?
That's right, Rochelle. We've got the 12th extension of the public health emergency by the health department. Secretary Javier Becerra saying today that this is going to be extended for another 90 days. That is the duration of the public health emergency. And this is, of course, we know because of the variants that are at play out there, keeping an eye on what the government can do. As you see on your screen, this is the number of times in the past that the public health emergency has been extended. The health department did promise states that they would give them a 60-day notice when they intend on ending it. So what that means is next month is where we should really be keeping an eye, because there have been rumors that the public health emergency could end by this April. I know that industry insiders have been talking about that month for quite some time, since last year, to be honest. And so we might be nearing that end of the public health emergency. This also comes into play as we talk about the cost of vaccines. We know that the vaccine companies are setting their prices as they expect to enter the commercial market sometime this year. So all the pieces of the puzzle starting to come together here.
We'll be keeping an eye on that date. And Anjali, we also received new details on the Inflation Reduction Act timeline for lowering the pricing of some drugs and medications. What's the latest there?
That's right. So if you recall, the Inflation Reduction Act was passed with the intention of starting with 10 drugs and negotiating those prices through Medicare, and that is for Medicare Part D. The first date that is important to remember is September of this year. That's where they're going to identify the first 10. Then by next September, they're going to have the prices negotiated to go into effect by January of 2026. That date was known. We did know that these prices were going to start to go into effect there, but it's important to keep an eye on because this starts that process that many have been excited about in terms of, capping spend, especially for Medicare, when we know it's one of the biggest revenue sources for these companies. Now, other parts of the Inflation Reduction Act have already been put in place, including the capping of insulin prices, including, watching the price increase of certain drugs for Part D and Part B by last year and this year. So all of that really starting to come together, but this really big part, the more interesting part, which is for the first time the government being able to negotiate prices, that's starting to come together. And so this is the first look at the timeline and more details to come.
Definitely be keeping an eye on what we're seeing with those. I know it'd be welcome news for a lot of consumers out there with times already being quite tough. Anjali Kemlani there. All right, coming up, we recap all the issues from the airlines this morning and do a final check of the markets. Stay with us. Job cuts spreading. Asset management giant BlackRock announcing it's cutting 500 roles. This according to an internal email seen by Yahoo Finance. Now, the memo cites a reallocation of assets, with the layoffs impacting around 3% of the group's workforce. BlackRock says it's vowing to, quote, manage resources prudently. It's scheduled post-fourth quarter results on Friday. And also taking a look on shares of major airlines this morning as flights across the U.S. have resumed this morning after the Federal Aviation Administration previously ordered carriers to, quote, pause all domestic departures due to a security message failure. Now, normal operations are resuming, but delays from the ground stop continue to grow. More than 5,000 flights in or out of the U.S. have been delayed thus far today. All right, well, before we go, let's take a look at a final check of the markets. We're seeing some of the buying action continuing to pick up as we see we're heading towards the highs of the day. We see the Dow there up about 0.33%, up 105 points. The S&P up about 0.2% there, 24 points. And the tech-heavy Nasdaq, the strongest gainer of the day so far, up about 1% on the day. Well, that'll do it for me. I'm Rochelle Akufo. Thanks for watching Yahoo Finance. I'll be back 11 a.m. Eastern tomorrow.